On July 30th, 2026, I made $120,314 in one day, and I'll show you the proof from inside my brokerage account. And while many AI and chip stocks were down over 50% in July, we made money in July. SanDisk fell 57%. ARM fell 51%. Marvell also fell 51%. And a $45 billion hedge fund was liquidated. Even though I owned a lot of those same AI companies which fell over 50%, I still finished profitable in July. That's not luck. That's a hedged, disciplined system, and I'm going to show you exactly how it works. Stay till the end and I'll show you a second month that proves the exact same thing. March 2026, where the market fell 8%, yet we were down less than 1%. July 2026, the AI trade came apart. You can see SanDisk on the left and ARM on the right. SanDisk, the June high was 2354, the July low was 998. That's a 57.6% decline. ARM, its June 2026 high was 452.70. Then in July, it fell to 222.56. That's a decline of over 50%. Marvell also fell about 51% from its June high to its July low. Yet we were profitable in July. How a drop becomes a wipeout. Leverage multiplies the drop. Using 4x leverage turns a 50% decline into a total loss of capital. And this is exactly what happened to situational awareness, which was Leopold's hedge fund. The second step, which is the margin call, arrives. Lenders don't wait for your thesis. They want collateral today. Then, forced liquidation sets the price. You sell at whatever the screen says, which is usually the exact bottom every single time. Being wrong doesn't blow up your account, but being leveraged and wrong does. There are two ways to be bullish on the same stocks. Buy the shares and lever up. You pay full price today, and a 50% drop needs a 100% gain in the stock price. Then if you use leverage, that turns into a margin call. A better strategy is to get paid to enter. They pay me cash up front to promise to buy a company I already want to own at a price I'd be thrilled to pay. If the stock never gets there, then I keep the cash. If the stock does fall, then I get to buy it at a huge discount and I still keep the cash. Basically, the market is paying me to buy the stock at a huge discount. 12 seconds for anyone new. Skip ahead if you already sell puts. Selling puts is a buy it on sale order below today's price where you get paid to own the stock. If the stock never gets there, you keep the money. If it does, you own the company at a huge discount. That's it. Back to the magic trade structure. What I actually had on, my finance bull trade. I sell a naked put at a strike where I genuinely be happy to own the company. That premium finances a call debit spread, which is my upside. About 85% of the time, the whole trade opens for a net credit, which means that I'm paid to enter the trade. I ran this across semis and AI companies all month. SMH, Micron, ASML, ARM, TSM, Taiwan Semiconductors, and Marvell. I call this my finance bull trade. When the semiconductor stocks finally stopped falling and turned higher, every one of those positions gained at the same time. Here's my account on July 30th, 2026. On the left, you can see the actual screenshot from inside my brokerage account. SMH was up around $32,000. Microsoft was up around $22,000. Micron was up about $21,000, etc. Now, a lot of people on YouTube will wire money into their account, screenshot the balance going up, and call it trading gains. But not me. Every dollar on the next screen is a gain from actual trading. No deposits, no transfers. It's on the statement, and you can see the line that says so. So let's look at the entire month, and then a second month where the market also fell, yet we dramatically outperformed. The same month, start to finish, you can see $45,000 in profits. Year to date, we're up around $272,000. And then you can also see our market value over time, where we're crushing the market with much less volatility in our returns. Our trading structure wins whether stocks go up, down, or nowhere. If the stock goes up, the call spread pays us, and I keep the credit when I open the original trade. If the stock goes down, then we're assigned at a strike price I chose because I'd be happy to own the stock at that price, and I keep the original credit. If the stock goes nowhere, then everything expires worthless, and I still keep the cash from when I open the trade. Now, July 30th was not a rebound that bailed me out. I was hedged going in. The call spreads were already paid for by the puts that I had already sold. And while I owned several of the names that fell by 50%, my account was still dramatically positive even when the market hit its lowest point. If you remove July 30th from the month, I still crushed the market in July. The rally made the win bigger, but it did not create the win. That's the same behavior that you'll see in March 2026, when the market fell by about 8%, yet we were down less than 1%. We're disciplined, we're hedged in every market environment. The number one mistake that I see traders make, and it's not picking the wrong stock, it's size. Selling more naked puts than the account can actually take assignment on. 2 NVIDIA 145 puts tie up about $29,000 in a cash account and slightly under $6,000 in a Regulation T account. Same trade, same risk. Wildly different capital requirements. Knowing which account you're in is half of sizing correctly. And then you also have to know what your margin requirements are once you're assigned. It's really important to size to what you can actually own. What discipline actually looks like. A member of my trade alerts had a 322.5 strike on Google that was in the money. And Google traded down to about 319 on July 24th. He rolled the strike down to 315 to avoid assignment, which is understandable, but it was the wrong call. Assignment in this case was the win. Google was back above 370 within a few weeks. Owning the shares at 322.5 would have given him about a $5,000 profit for every single contract that he was assigned. That's why it's important to pick a strike that you'd love to own at, then let the system do what you built it to do. Assignment is not a failure. The second month that I spoke about earlier, which is March 2026, the market fell by 8% and my account was down less than 1%. Same windows, but we used our structured and disciplined trading strategy. 2 different months, 1 structure. So there you have it. That's how I made $120,314 in a single day and finished July up by $45,522 in a month where AI stocks got cut in half and a hedge fund blew up and was forced into liquidation. We use a disciplined system, sized to what I can actually own, with hedges already paid for before the selling started. The people who got destroyed weren't wrong about AI, they were over-levered. If you use the right system, you don't need to call the bottom. You need a system that's still standing when the sell-off is at its worst. Win when you're right, win when you're wrong, never gamble. Quick word on who's telling you this. I'm an Ivy League graduate, former Wall Street investment banker. I worked at Morgan Stanley and CIBC World Markets. I've traded options for over 10 years, and I'm one of the very few people on YouTube who shows real brokerage statements without wiring in subscriber money to inflate the balance. If you want my exact trades in real time, there's a 14-day trial available at BestStockStrategy.com. And tell me below by leaving a comment, which stock should I break down next? And if you want to see one of these trades built from scratch on Google, the exact strikes, the filled order, the expiration dates, the credit that I was paid, it's on the screen right now. Click it. That's the video that YouTube thinks is the most valuable to you right now. Win when you're right, win when you're wrong, never gamble.